Hello, and welcome to Question in a Bottle. In this series of short discussions, private investor Mark Atkinson answers questions sent in by listeners and subscribers to his main podcast, The Desert Island Investor. So, let's take a look and see what's in the bottle that washed up on the beach today.
Right, Paul, this is a question from Joseph Harbin, who asks, Mark, in the last episode when you talked about Intertech, you mentioned buybacks. What is your opinion on buybacks or paying dividends? Well, thanks for the question, Joseph. However, you've given me something of a false choice. It's not necessarily either or, but you have other options, and there are good examples of paying a dividend or even a progressive dividend and having some element of buyback. One criticism is, do management have no better ideas of how to grow the business either through internal organic investment or through acquisitions, and that buybacks are somewhat unimaginative. Management could counter this with, well, we believe that the shares are undervalued and we cannot see any better investment than investing in ourselves. Sometimes businesses plough resources into destructive acquisitions, and in hindsight, the buyback option may well have been a more favourable one. Some buybacks are from companies with a net cash surplus. Others have debt on the books, and you could focus on paying that debt down as a first priority. And again, where is the wisdom in a company actually taking on debt to buy its own stock? Now, if a company is doing a buyback, you're hoping that they're getting good value and buying it below intrinsic book value. And you'd like to think that management have better visibility than anybody. But just like private investors, they can get a purchase wrong. And let's take the example of Zyrtronic, where I recently became a non-executive director and it's proceeding through a solvent liquidation. But as recently as May 2022, the shares were being bought back at £1.65. Now, in hindsight, the business was dying, right? And presently, FRP are given a liquidation range of between 48 and 58 pence. So sadly, back then, this destroyed value. Now, the magic of buybacks is that they have a magnifying effect, and any profit is divided by a fewer number of shares and therefore boosts the earning per share, even if there's no organic growth in the business, and should help boost the share price. And director options are triggered by share price targets, so it could be an incentive for directors to plough some resources into buybacks for their own self-interest, and that's something to monitor closely, I would suggest. A phrase usually used in relation to buybacks is returning money to shareholders. Now, strictly speaking, the money is returning to the exiting shareholders in the first instance, with future earnings distributed by those remaining on board. Presumably, if you are invested in a company, you like the company. So if you do nothing, a buyback will in effect increase, albeit fractionally, your holding in the business, and probably at a more economical rate than what you could accomplish yourself. One of the problems with a buyback is that it's not as tangible as a dividend. That physically lands into your bank account or on your investment platform, and you can do with it what you want. You can spend it, you can reinvest it either in the business itself or another business of your choice. And now it's anecdote time, and I'll share the story of an investor I knew who he had a pathological dislike of buybacks, full stop. He liked his dividends and that warm feeling at looking at it on the screen. And he went on and on about buybacks, and one company in particular, I can't remember the particular company, but let's call it Company X. And he just said, I want my dividend, not a buyback. On and on he went. And the company in question had a dividend and a buyback. And sometime later I asked him what he did with his dividend in Company X. What did he finally do with it? And he said, I bought some more shares in Company X. So he was a higher rate taxpayer. Therefore, at the time he paid 40% on his dividend, and what was left over was reinvested, rather than, the company reinvesting that money internally via the buyback that he wanted, that he didn't want. So depending on your personal circumstance, it could be more advantageous eventually to pay capital gains at a lesser rate at a time of your choosing, rather than, tax on the income that comes in through your dividends. Another benefit of buybacks is that it's a little like special dividends. You are managing expectations, and you can turn them on and off a little like a tap. Businesses really don't like cutting dividends for the negative message this sends, and often companies continue paying a dividend when there's not enough cover, and it's unsustainable. But there's a reluctance to cut. Certainly at the first instance, and often increased dividends are therefore, conservative, and management don't want to overstretch themselves and set an unsustainable target for forthcoming years, especially within cyclical businesses. Special dividends and buybacks are perhaps suitable as circumstances allow. Another use of buybacks is to try and prevent opportunistic takeovers, and it's been argued that shares listed in the UK have been undervalued for some time, and this is reflected in a number of bargain basement takeovers. By management buying back stock, this could vacuum up some of the float out there before somebody else can get a foothold, and again, hopefully through this, the earnings per share will help the share price and deter that takeover. Then there's none of the above. Companies can often sit on levels of cash beyond what's needed, and I like cash in a business. But again, beyond a certain level, what is it achieving? Surely it can work harder for the business better than sat on deposit, often earning less than inflation and actually eroding value. Used judiciously, buybacks can be an effective tool, a lever for management to pull alongside and complementing other actions. If we take MP Evans, they had a progressive dividend for decades. They've had strategic earnings enhancing acquisitions, utilising their current infrastructure with great synergies, and they've also had a modest buyback in place. So all these actions together have a nice magnifying compounding effect. So Joseph, as usual, no right, wrong, black and white response, but hopefully a few thoughts on the thorny subject of buybacks, which I would imagine will never disappear. There have been a lot of companies leave the London stock markets, and also there's been some aggressive buybacks across many businesses. So we're seeing a large degree of contraction in the actual tradable shares. And I would be interested if anybody can actually put a number on that.
Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. If you have a question for Mark for our Question in a Bottle podcast, just complete the form on our website, thedesertislandinvestor.co.uk. Thanks again for listening. See you next time.